Traders find liquidity concepts hard to understand, and even more advanced traders still struggle to identify and spot the liquidity on the charts. Why is that? Because liquidity is met everywhere a price has moved, so it can be very subjective. We are all looking at different levels and so on. So in this video, our goal is to make you understand liquidity concepts. We will show you how the multiple different types of liquidity and how to use them. Liquidity concepts will become easier for you to understand once you know where to look in the markets. So let's get into it. Starting off with the introduction, we must understand what is liquidity in the first place. The liquidity is the ability of a financial instrument to be traded, so bought and sold. Financial instruments, you probably know what they are. They can be stocks, currency pairs, crypto, gold. These are the markets we usually trade, but liquidity refers to all financial instruments, so things like real estate too. A market is liquid when participants known as traders constantly exchange the instruments, explained in a simple way. A liquid market is a market where a lot of traders buy and sell, so there is a large amounts of volume. Therefore, a lot of money traded. So this allows and makes it easier for a trader to sell at a better price because there are a lot of willing buyers. And the other way around too, so it also allows buyers to buy a certain stock, currency at a good price, where they want it without large differences in slippage, because there are enough willing sellers for the exchange to happen. As you probably have heard before, Forex is the most liquid market. Certain economic factors like the money supply constantly increasing makes currencies even more liquid as time passes by, and buying or selling currency is accessible. Retail banks and other similar financial institutions allow exchanges at any time when you want. You can even open a trade, because that was trading Forex is. For example, when you buy on the Euro-USD pair, what you do is selling USD for Euro. So basically you use leverage to borrow USD and exchange it to Euro. And if you manage to profit from it, you sell the Euro and buy USD, and now you have a higher USD balance than before. So the point is, currencies are very liquid, because you can exchange them at any time, compared to something more illiquid like real estate, where you need to find a willing buyer or seller for a longer time period. So this makes liquidity concepts very important, even crucial, because liquidity is what moves the markets and helps retail traders like us and smart money traders like institutions and banks to open their orders in the markets. Now we should really worry about liquidity because we have too little impact on such large markets. On Forex, gold, and a high-cap stocks, we can open positions with basically any size, and we won't find execution problems. We excluded crypto from this because crypto is an illiquid market. Coins like Bitcoin and Ethereum are fine, but if you trade coins with low liquidity and low volume, you might find yourself actually moving the market, having a significant impact on the price with not so much money. So we talked about how we don't get really screwed by liquidity issues on highly liquid pairs. But large financial institutions, so smart money, they can't just open positions with 100,000 lots, because there needs to be 100,000 lots of the opposing position willing to accept the exchange. And only them, the smart money, have such large amounts to trade with. Now, in order to spot and understand liquidity better, you need somewhat of a change in mindset. You probably have heard before of retail trading patterns like double tops. If it would be that easy, trading would not be so difficult. What we need to know is that retail patterns are drivers of liquidity that are often taken by smart money. So what that means is that smart money uses the retail traders' liquidity to load their orders. Alright, this was so far the theory on it. Now time to move into the practical details. Starting with the liquidity types. Liquidity can be seen and identified above any high and below any low. Why is that? Because there sit a lot of stop losses and pending orders. Liquidity can also be equal highs and equal lows, often seen above or below retail trading patterns like the double top, double bottom, and price consolidations. What usually happens is, for example, you see a ranging market that hits the same highs multiple times. So what often traders do is short selling the high because they look in the recent past moves that it has worked. Sometimes it works, but more often than not what happens is the price breaks above, takes his stop loss, and the price goes down to the take profit when the trade has been already closed. This is one of the most frustrating things that traders experience. And why does it happen? Because a smart money institutions has probably seen many stop loss orders and they push the price to use their liquidity to be able for them, the smart money, the open more large positions. This certain move, the move that broke above just to take stop losses, is called a liquidity grab. The term is easy to understand. You basically know what it does from the name. It grabs liquidity. A similar scenario happens often on double bottoms. So we have the ranging market on the downside that creates the same lows for some period of time, and the traders buying the bottom over and over again, loading up the area with a lot of liquidity. Smart money sees it and capitalizes on it by creating the fake move, which is called the liquidity grab, to take their stop losses, and then price shoots up, leaving many traders with losses and frustrations for getting tricked. The next type liquidity is the structural liquidity. They can be structural areas on the higher lows, higher highs, lower lows. We will present it in detail very soon. Another type of liquidity is the false or fake trend change. This is met when a market creates a false change of character. As example, so it goes from a downtrend and creates a change of character into an uptrend, but the uptrend does not hold, and the price quickly continues the downtrend. The trendline liquidity or the channel liquidity, this works well in trending markets. These are the main types of liquidity that we can use. Now we will take each of them one by one in detail, with charting examples. Liquidity from highs and lows. Every high and every low has liquidity, and it can come in multiple ways. A single high or a single low, an equal high or an equal low, and an old high or an old low. You must understand that the high time frame is the most important one. Let's look at the first example. So, the markets form a supply zone from where price has pushed down, then pulls back, and what often happens after is price moving away from the structural zone. In this case, that zone is the supply. This high is what is called an inducement. The inducement is a major high or low that tricks or induces people into thinking the market has already ended its upwards or downwards trend. This is also a weak high, because it failed to break the previous major low. What this does is it tricks traders to sell. So traders would sell this weak high. Where would traders place their stop loss? Usually right above. And what we also have is a descending trend line on the lower time frame, and then the market does the manipulation move, going into the supply area and selling off, leaving those traders that shorted at the weak high and the low time frame descending trend line getting stopped out. These inducements are usually seen below a supply zone and above a demand zone. The next one is the liquidity from the equal highs and equal lows, having the push to the downside that leaves a supply zone, and what price does is creating a consolidation that leaves equal highs at the top and equal lows at the bottom. Now this depends on the bias of the trader. If you are bullish biased, you might look at the triple bottom and look to buy the next time price hits the same low. What this trader often does is placing his stop loss below the triple bottom. We can quickly see how bad this is played afterwards, leaving the trader getting stopped out by this move. Now if the trader is short biased, he is looking at the triple top. What he often does is sell shorting the next time price hits the same top. This trader usually places his stop loss above these highs, being confident in a downtrend. But this trader also ends up getting stopped out by this move. But a smart trader will see the supply area and will know not to join any trade until the price hits that supply, knowing many traders will get stopped out from a smart money manipulation, just to push price down after. Why down? Because it continues the initial trend, which is a downtrend shown by the first downside movement. And the last one, which you will find in a lot of situations, we have an old high, then a consolidation in which you would like to look for long opportunities. Because the initial move aggressively pushing to the upside, we assume this is an uptrend. So what the uptrend does is push, retrace, or pullback and continuation of the trend. Then the market takes the old weak high, but then what you will often see is price dropping off significantly and possibly changing the trend. Now the thing is, you can't certainly know that this is a liquidity grab or a continuation. If we ignore that, we already see what happened after. Right here, it can be a break of structure to the upside, so a scenario in which the price has more increase. The way to identify if it is a liquidity grab is to wait to see what price does shortly after. If it drops down and takes the last low, then the trend has changed and we could wait for a pullback to the upside to sell this market. But if price drops and it holds above the previous low, then this still is an uptrend. Therefore, it is not a liquidity grab. In this exact scenario that you see, it is a liquidity grab. Because price breaks below the past low, pulls back to the upside, and constantly breaks down lows. So the market is turned into a downtrend. So let's look at some examples. The market has initiated an uptrend, hitting the major high of the trend and pulling back or retracing. The retrace creates a descending trend line. So traders seeing the trend line support touching and bouncing up, many traders might have entered buy orders. Where do they usually place their stop loss? Below the trend line. And that is easily seen how smart money just recklessly take their stop losses by pushing the price down. So buyers are out of the positions. But there is still a large level of liquidity sighting at the major high that smart money eventually takes out. Now we have two options: how to know if the move is a reversal or just a liquidity gap. By waiting for the pullback. If the pullback bounces up and starts gaining bullish momentum, that is a sign the market has a high probability of continuing going higher. But in this exact case that we see on the chart, if the pullback does not gain bullish momentum, and instead it constantly goes down, breaking the last major low, that is a huge indication that the major high that got broken was a liquidity grab. You don't need to time this movement perfectly, only to understand the structure of it and apply your own trading strategy that you like, because as we see the price after confirming the reversal, therefore the fact that this was a liquidity grab, the market starts filling the imbalance. And as we have shown on previous videos, a filled imbalance in a downtrend more often than not leads to a continuation of the downtrend by breaking the lows in the near future. Let's look at another example. This is the GBP against the US dollar on the 5-minute time frame. Market initially starts on a consolidation, then an upside candle with larger volume prints. This tricks traders into entering buy orders right after the candle closes. Those who had stop losses right below it got stopped out shortly after, just for price to aggressively shoot up in their direction. Not all buyers have been stopped out, obviously. Some surely had their stop losses at a lower level, so they caught this bullish momentum. But the point is, the reason this liquidation wick has printed on the chart is mostly because smart money saw a lot of liquidity sitting below these lows. So they take stop losses in order to feed their orders. After the upside movement, traders are starting to take profit by closing their buy orders. The buy orders are countered by matching sell orders. So sellers are starting to get in the market, which can be seen a loss of bullish momentum and price, slowly creating a downtrend trend line. With guess what? Liquidity above and below. The first ones to get trapped are buyers by the trend line breaking down first, shortly after the price breaks the previous week high, so it gives confidence to buyers that the market has reversed into an uptrend. Where would confident buyers place their stop losses? Often below the last major low, and the market moves into those levels like a magnet. The structural liquidity is the next type of liquidity we are going to cover. The structural liquidity are previous or old levels like higher lows, higher highs, lower lows, or supply and demand areas. The problem traders find themselves into is they do not respect the current trend and trade based on the past trend. Let's take a look and explain that. So the trader sees an uptrend, the market going up, and he marks his demand zones, waits or sets alerts, and buys when price hits the demand zone. But what the trader didn't have a look at is that the market has reversed. So we got this trend change or change of character that happened at this level. Why? Because the market has broken the previous major low. What would be the confirmation of the downtrend? Price being unable to break the previous major high and breaking again the low. So this certain price action pattern has instantly invalidates all the demand zones from the past, because why would you look for buys when the markets is going down? So what the traders usually do is buying this demand zone, seeing that the price goes up and gets too excited and happy, and then later he gets stopped out. And this happens over and over again for the rest of the demand zone too. And this process repeats on the opposite way. So the trader sees a constant downtrend, notices the supply zones, and sells when the market hits the supply zones, which is obviously leading him to losing many trades. The solution to this problem is to understand trend changes. Like we had before, once an uptrend reverses into a downtrend, all the previous demand zones become irrelevant. And once the trend changes from a downtrend into an uptrend, all the previous supply zones become irrelevant. The biggest lesson here is to trade the current trend, not the past trend. And let's jump into chart examples with this one. This is the Nasdaq futures market on the 4-hour time frame, a very popular and liquid market. Starting explaining from the left, the Nasdaq breaks an important low, and on the pullback, the price is unable to break the last major high. And by price breaking again the previous low, it confirms Nasdaq enters a downtrend on the 4-hour time frame. So, two supply areas are formed. The same price action continues on a downtrend, so lower highs and lower lows, creating two more supply areas. So traders have the opportunity to sell in 4 different supply zones. Some are shorting the first zone, some second, the third, and the last one, which is the highest up and often the safest zone to trade. It's the extreme supply or demand. But seller-biased traders do not take into consideration that the trend has shifted and changed right here after price has managed to break the previous high. So the first traders that tricked by smart money are the ones that short this supply zone. Where would these sellers place their stop losses? Often right above the supply zone, and their take profit often seen below the major lows. So what the market does is giving them confidence by slightly going into their direction and then stopping them out by breaking the supply. The mistake these traders have done is trading based on the previous market trend, when all they had to do is to watch the trend that is being played in the present. Opposite of the supply zones, in an uptrend price forms demand zones where price reacts and ends a pullback by pushing the price to break the highs. The same thing happened to the traders that sold at the next supply zone, while the smart money knew the demand zone was formed in an uptrend, so price should respect the demand instead of the supply. Knowing this leaves smart money with profits that other traders have probably lost because they didn't trade based on the current trend. And the same process basically repeats over and over until does a trend change and supply zones will get respected instead. The next type of liquidity is the highs and lows trendline liquidity. This is very simple and straightforward. In uptrends, this is usually met by price leaving a demand zone. The market slowly goes up, creating a trendline channel. In the uptrend scenario, it is an ascending trendline in which buyers open their orders at the touch of the bottom of the trendline, and sellers open their orders at the top of the trendline channel. What often happens is a sharp move to fill the demand zone to the downside. This move takes the liquidity of the buyers by stopping them out. The smart money way is to wait for the traders to get liquidated, and we enter a buying position on the demand zone like we did on the previous examples. Now the trend line can also be a descending trend line, and it works the same way, with liquidity sighting above and below the trend line. Smart money waiting for the demand zone to be filled. A quick example for the descending trendline liquidity. A demand zone in the left from which price shoots up, confirming the uptrend. The pullback, which forms a descending trend line with resting liquidity above and below the trend line. Price comes back to fill the demand zone, which stops out the buyers by breaking down the trend line. After demand fills, the smart money traders start opening buying orders that pushes the price up. Traders that still shorted the top of the trend line get stopped out. Then the uptrend continues and forms new demand zones that can be used. But be careful, because if the trend reverses into a downtrend, these demand zones will no longer be valid. The next liquidity concept is the liquidity grab. A liquidity grab is a stop hunt, sweep, liquidation. You might have heard these before. Essentially, they are all the same, and it indicates an intentional price manipulation to trap retail traders. A liquidity grab is a deviation or a break of the liquidity types we have presented previously. Usually after a liquidity grab takes liquidity by rejecting price action structures, and then it takes the market into the opposite side. A liquidity grab should be met hands in hands with a high volume or increasing momentum, so the price should react aggressively because it has taken liquidity. Therefore, a lot of orders have been opened and closed in a short time span, so that creates large candles or long wicks. We have already shown liquidity grabs on the charts in the previous examples. We have covered the theory on this one. And the last liquidity types is the daily session liquidity. The most important trading sessions are the New York session open, which has the largest volume on USD pairs. Then the London session and the Asian session. You will likely see how, for example, how London sessions takes the Asia session high, and then New York session takes the London session low, and all kind of sorts similar manipulation tactics. If you want to know when the sessions start, you can type on TradingView's indicator tab the indicator called Sessions, and it will display each session based on your time zone. And once we put it all together, we should be able to know to read and spot liquidity in the chart. This is the gold market in the 4-hour time frame. On the left side, the gold market started an uptrend, so an uptrend creates demand zones. This one, Then this one, which fills and price breaks up the high, creating another demand zone. An ascending trend line is formed, so there is an increasing number of buy orders opened each time the price hits the ascending trend line. Where to? They place their stop loss below it. And as seen, after they take the buyers out of their positions, just for the next candle to break to the upside, it's simple. A liquidity structure is formed, wait for price to liquidate that structure full of traders' stop losses, and then look for a trade opportunity. Here the price starts a significant downside movement, which means smart money are closing their buy orders and opening sell orders. This significant move breaking the previous major low, so we got a first indication of a trend reversal. Price pulls back, and again it leaves an ascending trend line with stop losses below it that they are taken very quickly. Then the demand zone fills out. The trend has changed, so this demand zone is no longer valid, even if price bounced up after touching the area. We have market what probably could happen next, for price to fill the supply zone and push it down to the second demand area. This move liquidating the buyers with open orders and stop losses below the demand zone. Alright, this is all for today's video. Thank you for watching, and we'll hopefully meet in the next ones.